Hello, I'm Gavin Preston, Managing Director behind the counter, private equity deal maker, CFO, and angel investor. I believe that corporate finance and private equity is not that complex. It's not as complex as made out to be. So I'm making these videos to bring private equity and venture capital expertise to everyday business owners. This video is about a scenario that comes up or could come up for business owners who are selling their business. So let's just imagine you've gone out, you're going to sell your business. You've done everything right. You've got people interested. You've got multiple parties interested. They provided you with, several offers. And every offer that's come in seems a little bit lower than what you would like. The market isn't really appreciating the value of your business. So what do you do if you only get low offers? This video is about the first option, which is you can try to negotiate out an earnout. The second option would be maybe vendor financing or a vendor take back. And the third option would be walking away. The other two options are in separate videos, and I encourage you, if you're in this position, to watch all three. But this one's about the earnout. So what is an earnout? An earnout is a deal structure where a portion of the actual proceeds of selling the business are paid after completion and tied some way to the business performance. So typically what we see is a buyer will pay a lump sum upfront, then will agree to pay something like, let's say, 50% of profits or EBITDA, let's say, above a particular target amount. So that they get to keep the target amount, and then everything that's above that target or above that budget is, 50% of it, let's say, would be paid, let's say at intervals of like 6 months for the next, year and a half. Now, that's an example, but it can be very flexible. It can be based on revenue. It could be based on gross profit, net profit, and it could be, I've seen them from 6 months all the way out to about 3 years. I'd say that's probably 3 years is pretty atypical, but I have seen it. So a good example was we had a client who, was selling their business, and we got 5 offers, and 2 of them were just kind of really low, and then 3 were okay. But they're all pretty similar. And the actual offers that came in themselves had 2 components to them entirely. One of them was the lump sum payment, and it did have a slightly higher multiple than average in that lump sum because the business had been growing. But then all of them had another component that was equal to anywhere from like 20 to 30% potential, at least, in terms of higher than just a lump sum payment. And it was all related in one way or another to the company achieving certain EBITDA targets and actually achieving above those EBITDA targets, and there being some sort of payment back. Why would you accept an earnout if you're looking to do this? Why would you want to do this? The simple reason or the simple answer is that you will get some sort of amount that's higher than just if you only do a lump sum. I mean, it could be 10 to 30% higher depending on what you get. So the pros of an earnout is, of course, a potential higher payout. Another one is that an earnout creates a smooth transition. So part of the issues is that sometimes business owners are very involved in the business, but also they want to know very much that there's a good transition to the new owners for all of the employees, maybe just the organization in general, things like the brand or the reputation or something, that there's a good transition to the next buyer. So that's a good pro too of the earnout. And the last one really brings us back to the original idea, which is that if the market isn't valuing your business, this is a possibility or a way of getting a deal structure to prove up that value and prove up that performance. So let's say you go out, you sell the business, it's only 75% of what you really wanted, but then you can show that value and prove that value over the next 1 or 2 years and get paid contractually for achieving that increase or that growth. The cons, though, there is some cons to an earnout. One of them is that there's a bit of a loss of control now. So you're not the only person, the only owner. That means that there's other people around the table who are going to make decisions. You have to have a good cultural fit, very likely, with the buyer. You have to be able to think that there isn't going to be a huge amount, because there's the possibility that there could be, disagreements and things like that between you. So you have to be able to control that or manage that risk. The second one is it is an uncertain payment, right? So an earnout isn't guaranteed. If the business doesn't grow in the way you're supposed to, I guess you could say, over the period of time of the earnout, you'll receive nothing. And so you will have stuck around in the business and continue to operate it after the sale, and yet not really got compensated in the way that you thought you would. And the final one is, of course, there's an extended commitment. So that last one is a real key one. So when you're looking at an earnout, you want to really look at what are the few things. One, do I trust the people? Do I trust the buyer? I'd hope you trust the buyer, but if you don't, then that's a problem. Other things, can you tolerate the risk? Can you take on the risk that's there? And the third one is really then asking yourself, what are you doing after the sale? There's three types of real sellers. One of them would be a type of person who, like, we did a deal with a short line agricultural equipment company back in Canada, and the seller himself was an engineer. He loved playing with new stuff and doing lots of things, but the fact was he just wanted to sell his business and move on. He wanted his retirement fund completely, put together, and then he wanted his estate completely ready. When the time comes to pass it on to, the next generation, he could easily do so. So he wasn't looking for earnouts or any other sorts of structures. He didn't want to be involved in the company, and there's lots of sellers who are like that. There is other sellers, though, that are completely the opposite. They're looking at selling their business. They're saying, hi, I can sell this to a bigger company or something like that, and it's a step up. It's a sell up, if you will. They sell their business into there. They get themselves a big chunk, a big check for the sale, but at the same time, this is an opportunity for them to maybe grow or get into another bigger company, a new phase of their career. And that's a great type of thing. That might be more like a software company, I would say, is probably like that. And then the third is, hey, I can be convinced. So I don't really want to stick around, but if somebody pays me enough, I will. I'll make it happen. So that's probably typical. So you need to ask yourself those kinds of things. So if you're going to negotiate an earnout, then you have to ask the question to one degree or another, why would a buyer accept an earnout? And the reason why a buyer would accept an earnout is 100% for risk management. Buyers want the strategic benefits if it's a sort of industry player, or they want, to get a return on capital and deploy capital if there's like a private equity company or something like that. They want to do deals, but there's only so far that they're willing to go in terms of valuation at any given point. So this is a mechanism of them getting the deal, getting money out the door and actually putting it to work, getting the strategic benefits from the sale. But at the same time, if the company is worth more, if it does grow more, if it does, then the buyer would be willing to pay more. It's just that they don't see that at this present moment. So by doing an earnout, there's the opportunity to prove up that value. It manages their risk as much, because if the value doesn't come there, they don't pay anymore. And that's what they want. The other side of it is, as I said, some business owners are still very integral to their business. Like, they're very part of it. They're very close to the customers, or they're very big on new sales, or maybe operations in some way. They're doing a lot of day-to-day work. So there needs to be some kind of transition, some kind of succession plan post completion of the sale, to ensure that when the owner finally walks out the door, that the whole bunch of value of the business walk out the door with them. So that the earnout is a process or potential solution where the buyer can manage the risk around the person and the owner that walking out as well. There's reasons why they would do it. Some of the tips for structuring. So if you want to structure a good earnout, the first one I would definitely say, I've seen it's gone wrong too, is that when you're providing that initial pitch deck or those initial proposals about buying it, you're getting people interested. There's going to be some section or some moment of like putting together projections for maybe 1, maybe 2, maybe all the way to like 5 years. Post-completion, showing what the profitability of the company could be. The key is to ensure that those projections are realistic and achievable, because there's a good chance that those projections will in fact become that baseline target of profitability post-completion that I was talking about, that the earnout needs to be at that level or above for you to get any additional payments. So you want to be optimistic, but you want to be realistic. And actually, on that point, we actually did a deal for a particular company where an advisor had come in. It was a giant curve up to the right in terms of the growth. We looked at it. This was a group of little 4 companies. They were a great little purchase. It was sort of the end of their portfolio. They weren't really involved. And, the buyers, the owners, that we were buying off of, the sellers, they weren't really involved. And we said, okay, fine. We're not going to question your big growth curve here. We're just going to set an earnout and say for the next 3 years, we're just going to put the targets exactly what you told me that was going to be there. Now, we bought the companies. The companies were great. They were a lovely little portfolio of companies that we owned. They were growing, but they didn't meet the targets at all that were there. And, or they did, some of them did a bit here and there, but the reality is we didn't end up paying out a lot of that earnout. And it was entirely because it was just too optimistic when it came in. So that's the number one thing I'd say. Put out your best foot, but ensure that those projections, you're selling those projections almost as much as you're selling your business. The second one is make sure that an earnout will work. So an earnout isn't always appropriate. Let's say you've got a psychology business and you're taking your psychology business and you're selling it into somebody who's buying a lot of psychology businesses and rolling them all up, conglomerating them all into one group, call the roll up, right? The problem is with that is in an earnout is that how do you know that your expenses, if the branding changes, like so many things could change post acquisition that really you're not really in control. It doesn't really reflect what you're doing right now. So, having EBITDA or something like that and saying this is what my earnout is based on, if there's not even really going to be a recognizable company in 6 months to a year post completion, that doesn't really make any sense. So what you can do is you can look at it and say, well, maybe there's a revenue target that could make sense. Maybe there's some other target that could make sense instead of doing it on profits. Maybe it sits as a subsidiary and it's not even, maybe the roll-up type entity doesn't actually even touch it for 6 months to a year. So you can structure the term around it correctly. Lots of different options around that. But it also just may be that, quite frankly, an earnout just doesn't work in that kind of circumstance. And so maybe you got to figure out something else, maybe something like vendor financing, or possibly you got to walk away. Any rate, the conclusion, earnouts are good. They can get you, I would say an estimate 10 to 30% more what you're just going to get from a lump sum. That's why you'd agree to it, but it does require you to stick around in the business, most likely. You can try to not, but it's probably better that you do. And there is some risk. There is some risk, of course, the business doesn't perform in the way you want, but it is a mechanism to be able to do a deal, do a sale, and have an opportunity to prove up the value in a circumstance where the market doesn't seem to be valuing your business correctly.